Welcome to the Nuts and Bolts of Real Estate. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I'm doing fantastic, Joseph. Beth and I, as you know, we're just confessing to each other that while we're fantastic and we love our lives, that we are also actually stressed because we're taking care of kids and family and running businesses and, keeping up with everything. I was telling Beth here that today is December 13th. I haven't even started Christmas shopping yet. Beth just got back from vacation to try and de-stress, and we're just stressing her out here with another podcast today. So let's crack each other up here and talk about what's going on. Well, first of all, Joe, to make us feel better, where are you today? So we know we can rely on you to de-stress us.
I'm sorry to disappoint you, but I'm in Enumclaw. And even
Oh,
though this strange thing in the sky that I'm not sure what it is, yeah, we're just in Enumclaw hanging out, trying to get the van sale done. We've had another buyer fall out that couldn't bring financing. So
so if
that is,
anybody wants to buy a van, you've got one. How much is
yeah,
it
130,000.
to live the dream, right? Awesome stuff. How about you? Do you guys ever do any vanning or camping and stuff, Beth? Or are you guys more like hotel
Well, you've
lovers?
met Matt, my husband,
Oh,
before.
yeah.
We're decidedly hotel people,
Yeah.
resort people. So we're not very outdoorsy other than running and downhill skiing. But other than that, we like a soft bed at night.
I hear you. I like to think that I'm like Joe, but the reality is I'm just like you, right?
Well, it's
So
harder with kids,
I know. Well, Beth and I, what were we just talking about? We're gonna confess right now that while we're here to tell you all the awesomeness about investing and all the success you can have in lending is what our topic is today, private lending. You know what? Beth and I were talking about how we get stressed sometimes, guys. What are you at? What's up with you right now, Beth?
Well, I just got
You,
back from our second home in the desert in Las Vegas, out in the suburbs, and brought my whole family down there. Not my children. It was a week off with my kids, but I brought my aging dad down and all of my siblings and their significant others, just so we could have some bonding time with dad. He's, not as well traveled as much lately and has some memory challenges. So we just want to get out as much as possible. Life is short.
I hear you. Life is short, right? And it is a good time. I hope everybody's gearing up for 2023. But as we were talking about, it's okay to also, chill out and take a break. And we were just talking about how stressed we are. I don't know why I'm sidetracked on that because I'm stressed myself this morning. But what we're going to talk about, which is going to help us all out with not being stressed, is an alternative today, an alternative to that hard charging lifestyle of chasing down deals and doing your own flips and, Airbnbs and all these great investment strategies. One thing we love about our friends, Beth Johnson and Matt Flynn at Flynn Family Lending, is that they advise us on alternative diversification strategy to always being the hard charging investor, and that is private lending, right? The topic of private lending was what we're going to cover today with Beth. In fact, as many of you already know, her and Alex Brashears have a new book out called Lend to Live. And we are excited to talk about that today and get to know a little bit more about how that book came about and how you guys might want to, as we're going into 2023, you might want to add in private lending as one of your own diversification strategies into your business. So, Beth, let's introduce you first. Joe, you kick us off with the first question, and we'll get to know Beth a little bit better for those that don't already know her.
Yeah, Beth, since it's been a little bit since we've had you on the podcast, we'd love to kind of refresh and let people know what your background is and how that led you into lending and real estate.
I think the last time that the three of us spoke together was at least 3 or 4 years ago, maybe actually probably more like 5 years ago. And at that time, we had just started Flynn Family Lending, and it was my husband, Matt Flynn, and I. And we just started growing from there with the fast pace of the market here in the greater Puget Sound area. And a lot of interest came up with us lending out people's money passively as a private money lender. And we would help match their money with active borrowers who are looking to invest in real estate, either as a flipper or as a buy and hold investor, whatever the nature may be. We helped kind of bridge that gap between borrowers seeking creative private financing and passive investors who didn't really want to hold real estate necessarily or had active W-2 jobs and families and wanted to just invest their money through us in a safe place with real estate backed so that it made it a lot safer and secure.
And so that's different. That's than somebody investing in somebody's fund, right? Like I think some people invest in like a hard money fund or something like that. And then they get a return and the investment decisions are made by whoever's running that fund, as opposed to what you do. Tell me if I'm right or wrong here, which is awesome. What you guys is that you make it more of a direct relationship between the borrower and the private money lender. You're like I call it like private money brokerage almost, right?
It is, in all intents and purposes, we're a broker. And you're right. I think you can think of those private debt funds, which is what they're called, where you pool your money and it's lent out that way. You can kind of think of it somewhat similar to a syndication. So you're getting blended into a portfolio of different loans. You don't get to make any decisions on them. And then you've got a return. And that fund manager helps deploy the capital and manage all of the loans in there. Whereas the way that Flynn Family Lending works is that we will lend out what's called a whole trust deed investment, meaning that we have essentially a one-to-one relationship where we have a borrower that wants to buy a property in West Seattle for $500,000. They're going to put, 15, 20% down or whatever that might be, or cross-collateralize it with a rental to help them put less money out of pocket. And then we'll match them up to a passive investor who wants to lend through us, and they get named on the loan documents themselves. So they're legally named as the loan or note holder, as it's called, and they get recorded on the deed of trust with the county. And so it's really safe and secure. It lets them have a lien position on the property themselves rather than the fund being the owner of that loan.
And in addition, that private lender gets to dictate their own terms, right? I mean, they're not, which in a syndication is very passive. I invest in syndications myself, and they fill a certain piece of the pizza pie for me, part of my diversification. But my returns are going to be lower. Somebody's taking a big bite out of that for me, as opposed to, this type of situation where, I don't know, you guys collect some points up front. It's all dictated by, you, the lender, right? Your fee is what? Taking points up front, Beth, or participating in the point?
We take the origination points, and we also will take a small spread. We call it a management fee that helps us support that loan during the entire duration of the loan until it's paid off in its entirety. And so our team will provide full concierge service from the time that sourcing those deals for you, presenting them, doing all of the due diligence, including making sure title is clear, ordering an insurance binder, providing really a summation of the entire loan, both the merits and the risks to our passive investors, and they get to choose. So I have some passive investors that only want to lend in certain counties, and they only have, a limited amount of funds, and they want to be maybe in just first position, and they'll take a lower interest return for an extraordinarily safe deal. Like maybe it's less than 60% loan to value or something like that. But then I have other investors who might have more funds to invest. They may have 7 figures or more to invest, and they're maybe a more sophisticated investor that wants to take on a little bit more risk. And so they may take on second lien positions or a higher loan to value, and then they'll get some higher returns for it as well. But the nice thing about it is that you get to pick and choose which deals that you want to take on. We'll never force feed them. We don't cattle call them. And so it gives our investors a lot of autonomy over what they select.
Yeah. And how often do you have people and people that want to be lenders bring you deals instead of them saying, hey, Beth, what do you have available? Do you oftentimes have people say, hey, Beth, I want to lend and here's this deal. Can we hire you to put it together for us? Is that something that's possible as well?
I've had a couple of investors come to me over the years, maybe a handful each year, to ask about a scenario like that. I'll tell you that we haven't really helped close a single one of them. And part of it is that once you start getting into the details of the loan itself, it just doesn't pencil out, or there might be too much risk for them. And so that actually hasn't come to us very often. The whole idea about coming to Flynn Family Lending is that we're going to help find you the safe and secure deals. We have, really solid deal flow and a good reputation in our market here, especially for our creative financing side of things. And so being able to have a large, swath of loans to be able to look through and pick one that lets you sleep well at night, that's the advantage. That's the benefit of working with us.
How does somebody, get on the list to look at those loans? They set up an appointment and get in your world and all that kind of stuff, right? I mean, they enter into how does that work? How do you start to get the opportunity to look at all your loans that are available?
They reach out to myself or Emily Schreiber-Sheets on my team. She helps manage all of our investor relations. And we like to do a fairly extensive onboarding process. As you know, trying to fund a deal, especially if you've got, like a 2 to 3 week closing period because you're trying to lock up a property, you don't want to let this go on for too long. And so we don't like having hiccups with our passive investors or capital partners, I like to call them, during the loan process. We want to be able to vet out what their needs and wants are with us well in advance of that. So they reach out to us. We give a prospective investor packet for them to look through, including a redacted set of loan documents. And then we get on a phone call or meet in person or do Zoom so that we can help answer any questions. Because invariably, you're going to look at that and it's a lot of legalese and it's going to strike up a lot of questions about what if. What happens if there's a late payment? What do I do at the end of year for tax-wise? What happens if the loan goes into default? Tell me a little bit more about how that works and what your team will help support us with. So we like to go through that iterative process to talk through some questions and concerns that they might have. And then from there, based on their, kind of defined deal criteria, we'll send them some recently funded deals and have them look through those on a 2 to 3 page overview that we send, and they can go sniff around the internet and look at pictures and all of the documents we have. And then they tell us which ones they like and which ones they don't. Sometimes it's a yes, sometimes it's a no, sometimes it's a maybe. Like, I like this one, but here's some questions I have. Yeah. And we found that's just a really great way to be able to connect with capital partners and make sure that we're not only a right fit culturally and value-wise, but also that we have a really strong sense of what they're looking for, and we can help find the right type of deals that will fit their criteria and their loan amount and their needs and wants, and go on from there.
Oh my God. I feel like I want to give you my money right now. The thing about it, everybody needs to understand is it's kind of like when you're starting off as an investor, right? I always advise it's best if you ride along with somebody else, right? Make less money on the first few deals, whatever you have to do to get that education and that experience. I highly think that it's better to, when you're getting your feet wet with private lending, right? There's so many components to it, right? To make sure that all the I's are dotted and T's are crossed. It only makes kind of obvious sense that you'd want to work with somebody like Flynn Family Lending to get a few under your belt, I guess I would say, and learn the ropes, on your own until you want to start, tackling it on your own, just like any other investment, right? It's a diversification of a different type of investing. It's lending. It's fantastic. And we are excited. I imagine you guys, the word has spread so much over the years about what such a great opportunity that is. I want to talk to you about, let me get my notes up here, about now you guys, we've had other podcasts that we've done with Beth, and we're going to talk about those later with you guys. But I want to focus on this new book, Lend to Live, that you've written with Alex Brashears. And how did you and Alex meet? Let me give you a little background on that.
Facebook, believe it or not, social media brings people together. And I had always longed for a private lending community to belong to so they can ask questions. As you know, Julie, like the hard money space, the private lending space, it's pretty competitive. And you just can't necessarily call up one of your colleagues in your market and say, hey, how would you do this? And how would you do that? So over the years, as I was growing our business and learning to adapt, since this wasn't really my background. I had a telecom and technology background before Matt and I got together and formed this company. There just isn't a whole lot of material out there to help guide private lenders like ourselves on how to do it right, how to do it safely. And so I finally saw this community out there. I'd always thought about starting one up on my own, but it was just too busy. You know, didn't want to moderate a social media forum, couldn't really find associations that really cater to very small independent private lenders like ourselves. And she established one in the middle of COVID. And so that's how we connected. And she has an academia background. She's a professor, or at least she no longer is. She's able to quit her day job. And my background was in corporate training and development and instructional design. So I think you can see right there, we had, some education connections and this desire to help learn and grow, not just each other and ourselves, but other people as well. And it just grew from there. One phone call led to another phone call, led to her calling me saying, I'm going to go get us a book contract. I had this epiphany and I want to do this. And I said, hey, okay, you go do that. I'm really busy right now and I'll join when I can. But if you want to take this on, knock yourself out. And we hadn't even met yet, but within months, she was able to draft up some content, some just basic content using her own knowledge and some content of mine. Written content and webinars that we'd hosted together and some podcasts. And she was able to go out and secure not one, but 2 contracts.
Wow.
Yeah, it was just, nothing in my life ever really pans out the way I expected it to be. And this is no different. I really wish I could say I planned this, but it sort of just fell in my lap and an opportunity presented itself and we ran with it.
That is funny. It is amazing how when people come in, there's always been people, Joe being one of those people for me, when people come into your life that are going to, no person can do everything by themselves, right? And, when somebody comes into your life that you kind of, did you know it from the beginning? Like, I've had only like 3 or 4 people over a 20-year span that I feel have come into my business life that I feel like, oh my gosh, that's that person is going to make a huge impact on me. So you got to kind of have it on your radar, but that's awesome that you guys were able to do that. How long did this book take to write then? Sounds like you banged it out.
We did. I don't know what typical book writing timelines call for. I did ask our publishing team at BRRRR, what was the longest? And they said a couple of years. Wow. So our soup to nuts was 5 months.
Wow. That is fantastic. Well, let's jump back into this guy on why you guys all need to go buy this book, Lend to Live with Beth Johnson and Alex BRRRR. You're going to want to buy it here by the time we get done today. But let's talk about private lending and jump into that for a minute. And I'm not going to go like down to the little nitty gritty stuff because there's lots of podcasts that you've been on. We're going to drop, like I said, a few previous podcasts that we've done with Beth. One of them is podcast number 88, just called Beth Johnson of Flynn Family Lending. And also we've done podcast number 122, maximizing your borrowing power, with both, I think, Beth and Matt on that. And Joe will drop those in the show notes below, and you can have a Beth Johnson weekend ahead of you if you'd like to, right? Get her book, listen to a bunch of podcasts. Yeah. And of course, you guys have been kicking butt on bigger podcasts and bigger pockets podcasts and stuff like that. So you're going to get to know Beth all over the place, guys. Today's my take on it. So I want to jump into my Julie Clark questions on my little deep dive stuff. So I want to know, what is the difference from your perspective from hard money, private money, and gap funding?
Sure. You can ask like a dozen different lenders or borrowers, and they'll all probably tell you something different. We kind of went with the taxonomy that is pretty well known in the bigger pockets community, in that hard money really is, a brick and mortar office. You can call up a loan officer. They have like an underwriting team and loan processors, and they have access to what it seems like unlimited funds. And you can probably Google and research a half a dozen of them, or a dozen, probably dozens now these days, since there's a lot of national hard money lenders and regional. And then they offer some pretty canned lending guidelines, right? They might have credit requirements or capital requirements. But that's the space they operate in. Private lending, on the other hand, is really that elusive speakeasy. Like, private lenders exist out there, or Julie, you'd like this one. It's kind of like babysitters. You're never going to give out the name of your babysitter because then you might run the risk of not having the availability on a Saturday when you want to go out with your girlfriends, right? That's like private money lenders. I'm not going to divulge mine as a borrower because I want to make sure that they have capital to fund my deals. And so they're a little bit harder to find because private lenders, they don't necessarily do this as a day job. They may just have access to a retirement plan or some excess capital that they've earned over the decades of working a hard W-2 job, and they just want to lend it out safely. But they don't necessarily advertise. You have to figure out where they are, maybe go to some RIA meetings and local meetups and find them very organically. And then it's very relationship based too.
Right. So, but here we have Flynn Family Lending, right? And so if I'm a borrower though, and I'm thinking, how am I think part of the mental hoop for people is if I need to borrow the money and I haven't, I have to school up, what's the best way to, build these relationships? Am I going to ask my friends and my family? That's kind of, less comfortable. Maybe I, work all the time, or I don't have a lot of time to go to all these networking events where everybody in the room is, the beautiful part is they can go to Flynn Family Lending, right?
That's right. We're basically like a hybrid, right? To your
Exactly.
point, we kind of broker hard money or private money relationships between the borrower and our capital partners. Not all private lenders operate like us, so we're well known in the community, but I'm not necessarily truly a private money lender. Although Matt and I lend out our own money, having a brick and mortar and a market presence like Flynn Family Lending is somewhat of an anomaly. Most private lenders are out there just kind of lending out their own money on the side, or they'll work through partners like us. But there's, it's a bit of a tough business model to manage because, as you can imagine, I have a lot of different capital partners to please. I have a lot of deal flow coming in as well from borrowers wanting to get a loan inquiry. And so it can be somewhat difficult because we're going to be able to charge points. We have to maintain a certain business model here, but it's hard because if I had a fund and I just dumped everybody's money in there, well, then all I'm having to do is approve it and fund it from that fund, right? So it's a much easier business model to operate like a hard money lender. It's a much difficult space for us, like Flynn Family Lending, especially as we scale. It becomes a little bit more cumbersome and time consuming to handle something like that. But, a lot of people like going out and finding a private money lender because they may not have to make points. Maybe that individual just wants to lend it out and get better returns than they can, in the market or in CDs or annuities. And if they know the kid down the street that they saw grow up and he or she is investing in real estate and doing really well at it, well, then that's how those kind of relationships get established. So it's hard to find, but it can be very worthwhile to a lot of people. And that's what the book was catering to.
Oh, and that's great. People can also, you found all these people at Amazon or these tech companies starting these real estate investment clubs, right? Those are great places to join to try and, people are wanting to do deals, but there's probably a lot of people in there just wanting to lend money as well, right? Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. So, but what is there a difference between what gap funding is, or what is the definition of gap funding?
Gap funding it's not necessarily private money or hard money. It's really just utilizing funds to bridge the gap between what a first lien lender will lend out on, whether that's 95% loan to value for some of our local hard money lenders, and you're really well experienced, you might be able to get that. It's that 5% that you're trying to fund if you don't have the capital yourself. Right. For us, we typically require a little bit more money down on a property to purchase. So if we do 75% loan to value, then the borrower needs to come up with that 25% as a gap loan, typically in second position.
Let's talk about what a typical loan structure looks like for you guys. Like let's talk about your personal lending, that when you loan your own money, because you guys do that as well, right? What would the ideal loan structure or look like for you? You have points or what are the components of that?
Well, we'd like to keep our loan structure very conservative. Again, I'm using a lot of high net worth individuals, some just, everyday families that have access to savings to lend out. And the last thing they want to do is risk that. And so the one thing that can protect your loan as a capital partner is equity buffer. And that means if I'm going to put 70% down on a purchase, then that 30% between the loan amount and the actual value of the property, that's the equity buffer. And that means in case things go sideways, the market dips, the borrower screws up a little bit, or the GC has delays, then there's enough meat on the bones there to help cover you. And even though we're a little bit more conservative than some of our local hard money lender competitors, or even national and regional ones, that they can absorb that higher risk, right? We can't necessarily, because we're assigning a loan from a borrower directly to a lender. And so even though we're a little bit more conservative, we can offer a lot more creativity in terms of the structure of the loan that a lot of hard money lenders can't do because their banks won't let them, or, a lot of dependencies that hard money lenders have, we don't have because we're using truly private capital.
It's kind of like creative real estate investing, right? As a private money lender, you have the flexibility to create whatever terms that you want, right? Is that accurate? Or
yep, whatever lets you sleep well at night. As long as you're doing it safely and legally. In the state of Washington, you don't necessarily need to be licensed to be a private money lender or a hard money lender. There are a handful of states where you do have to have licensure, and there's a little bit different regulations, but in this state, you don't have to. And so really it's whatever you and the borrower come to terms with, no pun intended. If you want to have a safe equity buffer in there, like we structure, it's usually around 65 to 70% loan to value or combined loan to value, or you can go up to 85 or 90. It just depends on the relationships. For us, it is definitely a little bit more conservative, but we offer creativity, like I said, that hard money lenders can't do. So maybe I want to leverage your real estate portfolio, Julie, so that you can take down another, apartment building. Then I'll put a second lien on a building that you've had for a decade. You've got tons of equity in it, and you want to use that to buy a new property and keep some money in your pocket to help fund your rehab and to help have the cash reserves to refinance out afterwards. Things like that other hard money lenders can't do because their warehouse line of credit, that's backed by Wall Street, won't allow them to do such things.
I mean, right. So that's a way we're talking about, I think, loan to value being such a critical due diligence piece on private lending, right? And limiting your loan to value to protect yourself. You have the borrower. I think I heard on another podcast, you guys' analogy of the jockey versus the horse. I think
That's
was maybe on the, what is that? Tell us what that means. That means when you're looking at doing a loan, the jockey is the borrower, the horse is the property, right? Do I have
Right.
that? And
There's a lot of different things that you have to look at from a lender, private lender standpoint. And one is the capabilities and the capacity of the borrower themselves. In traditional lending, we would call that the borrower's character, their credit worthiness, their cash position or capacity, which would include, a little bit more about their experience in a particular real estate investment strategy. And then you have the collateral itself, the property. And so there's they call them the 5 C's of credit. That applies both with conventional lending, but it also applies to hard money and private lending as well. And so when we're looking at a particular deal, we really want to see the jockey, which is the borrower, versus the property itself, the project itself. What's the viability of it? What's the after repair value? Are they walking into a good deal with some equity on it? So my co-author, Alex, tends to look more at the jockey, which is a great place to start when you're a truly independent private lender, because again, as I mentioned before, it's relationship based. I might know the kid down the street that grew up and started getting into real estate, and I want to take a chance on them. I know they've got some good support in their network. And so I'll lend money. That's like Ursel on my team, Ursel Terrell. He actually was my neighbor's kid. And we have funded some of his investment projects. That's how truly individual private lending works. When you start to scale, which some private lenders just choose not to, but we really decided to start our private lending business as an active business and to take on investor capital of our own. But so when you scale out, you have to look at something a little bit quicker because you got a lot of deals coming through. And that's why I prefer the horse. It's a lot easier to rely on a property to help cover you. I always like to say borrowers or people disappoint me, but properties don't, so long as I'm looking at it properly. And so I like to place a whole lot more emphasis on the asset itself.
I think I'm in your camp, right? Because like you said, I mean, borrowers can't always control what's going to happen in markets and so forth like that. But if you're paying attention to the horse and protecting yourself with that loan to value, it seems to me, that'd be the way I'd do it. Let me get some other questions. Do you have to lend, when you lend, do you have to lend to an LLC or can you lend to an individual borrower?
We've done both. We've had some clients that have purchased properties individually, but as long as it's a business or commercial purpose loan, that's what we're in the business of doing. So we don't give personal or consumer credit. If you're trying to pay off debt on your primary home or trying to buy your first primary, we can't lend on that.
Right.
But if you're trying to buy a commercial building and you want to renovate it and stabilize it, then we can lend on that. So it doesn't necessarily matter whether it's in a business entity or an individual. If it is in a business entity, we always get a personal guarantee because we would need them to be recourse loans.
Is that so? I was going to ask you, so do you use recourse or non-recourse loans? Does that depend on who's the borrower?
Yeah, I mean, I think by far and large, it's been recourse. There have been a handful of instances where we have lent money out to, let's say, a self-directed IRA property that's being purchased in a solo 401k, something of that nature. Those types of loans have to be non-recourse to stay within the guidelines of what self-directed retirement plans allow. So in those instances, then yes, we've not done it as a recourse loan, but we've required a very significant equity buffer, much more than 65 to 70%.
And so you guys typically try and stay at 65 to 70%, but some of the lenders that come to Flynn Family Lending, it's everybody's choice, right? On how much loan to value they, want to put on a property, right? But smart investing tells you to buffer that. Let me ask you here. I'm looking at my notes here. Hold on. I'm going blind, so I have to look harder. Let's talk about that a little bit more. So what types of properties you can actually lend on based on the strategies, right? So we have flips, we have BRRRRs, we have, multifamily, we have Airbnbs, we have new construction, we have people that want to do house hacks. Can you lend on all those? I know the one that you probably can't lend on, but I'm throwing it out there. so everybody understands what that means. Because people come to other people and say, hey, I'm looking for a private lender. I got this type of deal that I'm working on, right? And so I think it's important for people to understand, what are the different types of loans that you might make on the different types of properties. Pretty simple on a flip. So if you're going to be a private money lender on a flip, right, you're either going to be in first position lien or second. Most of the time, those people are going to have a hard money loan. So do you guys loan in second position behind a hard money loan or not?
We have very seldomly. The reason we choose not to is because hard money loans tend to be short term in nature. Sometimes they'll offer shorter terms than we allow. And so it just doesn't seem beneficial to the borrower to do so. And if they default on the hard money loan, then there's some pretty punitive default interest that can wipe away your equity buffer in a heartbeat if you're not careful. So yes, we do lend in second position. Most of the time, we like to be behind a conventional or commercial loan that has longer terms and less punitive default scenarios around it. We'll lend on basically any asset class that is not owner occupied, at least from a residential standpoint. We've helped business owners buy buildings, and of course they were going to owner occupy it because they're going to operate their business out of it. That's acceptable. But if you're going to live in it, then that's not something that we can do. So house hacking is not really something in the cards for us. If you're going to buy a duplex and you're going to live in half and rent out the other half, unfortunately, that's not something that we can support either. And it's because Washington has some pretty aggressive consumer protection laws, homestead laws, and that's meant to make sure that people can stay in their homes and not get kicked out and become homeless. And so they're meant to be that way on purpose. And hard money and private money really fits the space of investment only and not consumer.
So if you're not going to want to be behind a hard money loan, right? I know when I first started private lending, I did it as a way that I was trying to make a relationship. I wanted to get to know some of these flippers I thought were stars in the space. I wanted to do a relationship with them. And so instead of them relationship building with me to get my money, in the reverse, I was like, hey, and that might be you as a new investor. You might want to get to know other people. And as a way to do that is to loan them money. But that's how I started, actually in the reverse, trying to make those relationships by lending the money instead of being the flipper who was looking for that money. But if you guys don't want to be behind a hard money loan in second lien position, well, let me back it up for a second. If somebody does go behind, right? Because there's people that do that, right? That they will lend in second loan position behind a hard money lender. Does the underlying loan documents have to allow the second, regardless if it's risky or not? Or maybe as long as there is enough loan to value cushion there between that first hard money loan position and you're going into a conservative second position, does that underlying documents with the hard money lender have to allow the second? Is there some rules there?
Technically speaking, yes, some loans might have what's called a due on sale clause. And so they can call the note due if they're subordinate loans. Generally speaking, though, we don't necessarily rely too heavily on that or investigate it too much. And that's because our loans are short term. And by short term, I mean less than a year. Typically, our loan terms are anywhere from 6 to 8 months to up to 10 months or 12. They're always less than a year. And so they're meant to be a bridge loan. And we can often act faster than a bank can, right? Banks are in the habit of lending out money, but they're also really into depository accounts. They're not really prolific in their REO. And so they won't really find out or even act on it as quickly as we can. So yes, there are some loans that might have that stipulation, and a lot of hard money loans do. They don't allow subordinate loans, or if they do, then there needs to be a subordination agreement signed with the junior lien holder, and it can just create a lot of confusion. So generally speaking, most banks, in the 8 years that we've done this, sorry about my face.
It's cool.
This that we're being blinded by sun that doesn't normally happen around these parts this time of year. But so we, yes, there are some things that we would want to look for, but generally speaking, for a loan that's going to be less than a year, our lenders and us, we're willing to take those chances and have never had an issue in 8 years.
Right. So loaning on flips we're talking about. We're going to talk at the end your alternative to not going behind hard money second, how you can still fund those flips if you choose not to go behind the hard money, which is the cross collateralization. But first I want to talk about, so just people understand, like if you're going to loan on a BRRRR, that's really a flip to hold, right? How do you loan on a BRRRR? How do you exit when somebody wants to hold it long term, either on a multifamily or a BRRRR situation?
It's similar to a flip, but we want to be really careful in determining what is that right loan amount. I mean, obviously, from a borrower standpoint, you want to have as much high a leverage. Some people, their philosophical approaches, I want to have as high a leverage as I possibly can, right? I don't want to use any of my own money if I don't have to. The downside to that is that it's borrowed money, so you're paying interest on it. So there's a sweet spot that every borrower and every lender needs to navigate, and that's what's the right amount of money that I need. Now, if I'm a flipper, it doesn't really matter because I'm just going to sell it. And so they're just going to pay off my underlying loan or loans, and I get what the net proceeds are. From a BRRRR standpoint, the whole strategy is I want to be able to get back not only what I put in from an acquisition down payment, but any money of my own that I put into rehab, I want to be able to recoup as much as possible. And as you know, BRRRRs are a little bit harder to come by these days in this market. Trying to get out as much as possible on the refinance is what the end game is. And so the cross collateralization helps borrowers do just that. It allows us to put a second lien on an existing rental and tap into that equity because, of course, right now, refinancing is super expensive. So a cash out refinance might not be the right way to go. But if I place a second lien on there temporarily and buy a new property, then now all of a sudden you can leverage that equity and have a higher loan amount. So we have
on the BRRRR, because the goal of that BRRRR investor is going to be wanting to get the highest amount of loan amount they can get on the exit, right? So they can recoup what they've got into. The solution on that, so you can lend them more on that property to make it easier for them to get that refinance at the higher loan amount, is that your initial loan amount needs to be higher on that BRRRR. Mm-hmm. And how you am I saying it correctly? And in order, right, since you don't like to loan more than 65 or 70% on a typical property, how do you get them to the point where on a BRRRR, if you're the lending on a BRRRR, how do you get somebody to the point that they're going to be able to accomplish their refinance goals, right? Not just pay you back, but actually, put a long-term loan in place for their long-term hold. And you are accomplishing that by getting your collateral and your security off some other property they have. So your loan to value is protected. Your loan is protected. It allows you to have a higher, right? Am I got the right idea?
We don't have, traditional lending guidelines. Like if you went to a hard money lender and said, tell me what your credit box is, or tell me what your lending guidelines, they'll tell you, you need to have a minimum credit score of 650. You need to have a minimum of 20% down. You need to have a minimum of 3 months or 6 months cash reserves to cover your monthly interest payments. And you have to show proof of that. Creative private money lenders can operate a little bit more loosely. And so while I say that we like to be a little bit more conservative and have 65 to 70% combined loan to value, I might also fudge that too, because I'll look at the equity buffer in terms of dollar amount. So 70% loan to value on a $2 million property in Bellevue is going to look a lot different than 70% loan to value on, a single family residence in the Hoquiam, Aberdeen area. And so depending on the amount of money that they need, I might place a second lien on that property in Bellevue because that, 20 to 30% equity buffer they have there, that's worth millions. And so I can cross collateralize that and then help them buy another property down in Tacoma to BRRRR, and we have no problem at all.
The goal on the BRRRR, when we're funding people's BRRRRs, I am asking it this way because I think people will be approached like, hey, I need a loan. I'm looking for a private money lender. And you need to understand the difference as a lender on the different types of deal structures to understand the best way to position yourself to get paid off or what those risks might be. So BRRRR investing is popular, right? I mean, and the idea is you need to borrow as much as possible. How are you going to do that? offering up could that be somebody's personal residence that you cross collateralize with, or does it have to be another investment property?
It can. Generally speaking, we don't do that. As I mentioned, there's homestead laws in Washington that would prevent you from, if they were to go into default and you had to foreclose. Well, it's just not a real good feeling to have to foreclose on somebody's primary, even though it is a business purpose loan and you could do that. We tend to shy away from it. We used to do that. The homestead laws and the minimum threshold has been increased quite a bit in the last, I think it happened about a year and a half ago. And so it's just not a good advisable option, in my opinion, to place a second lien on a primary residence.
But that also means then when you're putting a second lien on somebody's other collateral, their other rental properties or whatever, does that mean they need to own it by themselves and not have a partner? You know what I mean? On that property?
We would need acknowledgement from the partner themselves. So all the partners, and that hasn't really been an issue for us in the past, although some, they can't get their partner to agree to it and they're trying to go out on their own. But generally the partners is willing because they're trying to take down that property with the person that's reached out to us.
Right. Meaning that you're buying the new property with your partner, right? But some people might have more than one partner. I'm just pointing out to you guys, like when you're thinking about making a loan and somebody says, yeah, I want to do this BRRRR deal, and you want to be smart like Beth here, and you say, well, I'd like to help you maximize out your refinance so you can get all your purchase price plus all your renovation dollars out, right? That's the goal, right? We want it to be a win-win on both sides. And then they're going to want to do more loans with you because you're smart and you've come to them and you understand the investor's exit strategy as well. Hey, I'd like to help you get your purchase price plus all your rehab dollars out. I can't loan you 100% of the cost on this property because that takes me over my desired loan to value threshold. So I'm protected. If you have another investment property, because it can't be your house, and you don't, it's either the same partners or you don't have any partners, I can put a second lien position in there, and then I can feel secure to loan, right? You can, how it works is you're getting the money out of that. They're getting the money out of that second deal, right?
You're basically replacing down payment or rehab with equity. And again, it leaves some money in the borrower's pocket, but it also shores up the deal for the lender themselves. One advantage that people like working with local lenders like Matt and I at Flynn Family Lending is the fact that we are also investors. So we understand and are empathetic to what an active borrower might need. And the reality is that if you're working with a 1-to-4 unit and you're putting your own rehab money into it, if I take that to a conventional lender to refinance, they may not give me money back for my rehab. I mean, I think that there might be a handful out there, but generally speaking, by far and large, none of that unsecured money used in your own rehab can be pulled out in a BRRRR. Or if you do, then it's considered a cash out refinance. And as you know, this year with all of the Fed rate hikes and nonsense like that, interest rates are higher, loan to values are going down a little bit. People are having to come to close with cash because it's not penciling out the way that they needed to. So a rate and term refinance really is the way to go because it's cheaper for the investor. Typically it'll be lower points and it'll be a lower interest rate, but it'll also max out their loan to value. If I'm going to refinance a 1-to-4 unit with a conventional lender as a rate and term, I can go up to 75, 80% loan to value. If I'm going to do a cash out, some might not do it anymore these days, which is unfortunate. But if you can find a lender that will, usually they'll only go up to 70 to 75% loan to value and your rates will be higher. So trying to get that sweet spot so that they can do a rate and term refinance and pull out as much of their own money as possible, that's the sweet spot in using cross collateralization.
There you go, right there. So same on multifamily, right? Or we'll call it, do you loan on any deal size on multifamily, or are there some limitations on deal size? Just
generally speaking, we like to do loans less than $1 million, although we've gone above that. Again, our coffers aren't quite as big as some of the other larger lenders in town. I would say for 5+ residential units, and when you're refinancing out with a commercial lender, you don't have the same stipulations, right? So it's really the 1-to-4 unit that works the best in terms of cross collateralizing so that they can max out the borrowed capital so that they can refinance as a rate and term. But that doesn't necessarily mean that for a commercial property that you don't want to cross collateralize to take it down. A lot of commercial loans, just like conventional, have some pretty stiff cash reserve requirements. And ever since COVID hit, you saw at least a minimum of 6 months cash reserves, because they just, in an unstable market, they just want to make sure that you have enough cash to be able to cover your monthly payments for a certain amount of time, which is ironic, right? In a cash out refinance, you have to show proof of funds in order to get money out. It's kind of random, but in a commercial loan, you need to have some cash reserves in place. So sometimes cross collateralizing allows them to keep the 6 figures of capital that they need in their bank accounts in order to qualify for a commercial loan.
Exactly. I mean, there's just so much more to think about on there. And we have covered this cross collateralizing on our other podcasts, like we said, with Beth and Matt, that Joe's dropping down below. Are there any strategies that you personally would not lend on, investment strategies or property types? Like if somebody said, hey, Beth, I'm going to do this Airbnb deal, right? I'm just trying to cover like, what are the hot investment things that people are going to come to, asking for private loans on. Hey, Beth, I want to do an Airbnb deal. Would you, what does that mean to you? You're going to underwrite it as just a rental property and not count on the Airbnb income, or what?
Exactly. You just hit the nail on the head. Really, what we're looking for is, what is the exit strategy? Or hopefully, what are the multiple exit strategies that a borrower has in front of them? Part of the reason that we keep a low loan to value is that we know one of the secondary or tertiary exit strategies that the borrower might not even be considering is they can go get refinanced out into another hard money loan, right? And so, there's hard money lenders that will go up to 85, 90% loan to value. If the borrower screws up, then I know I can refinance them at a minimum out with the bridge lender. But for some of these other types of investment strategies that are a little bit more popular, I should say, we just have to back into it and what their exit strategies would or could be. The problem with a short-term rental is that that's really much dependent upon the market.
Right.
What the market will bear, it depends on the jurisdiction and if the municipality enforces changes on whether or not you can do a short-term rental, so that it affects their market value. But market rents, long-term market rents, typically are going to be a lot less than short-term rental. But again, you need to see that seasonality. You need to see at least a full year of P&Ls before they can actually get refinanced out. And there's just not a lot of lenders out there that will refinance based on the short-term rental income. They'll probably base it on market rents, and DSCR loans will do just that. So if you can't finance into a conventional loan, maybe you've maxed out your 10 loans, or you just can't qualify because your DTI is too high, then those debt service coverage loans are really important, but they're called long-term rental loan programs for a reason. They want to base it on market rents or existing term leases, not short-term rental income. So we'll entertain them, but I know that they're going to need probably 12 months or more to get out of that loan. Sometimes if it's a larger property, maybe they need to be able to get an SBA loan. If they found a lender that will lend using short-term rental income, like I said, you'd probably need at least a full year of P&L before you can refinance out with a commercial loan. And so that's the types of things that we're looking at, is what are the viable exit strategies? And being a little bit more realistic and conservative about them is, if all of a sudden you can't get the short-term rental income that you wanted, what will the market rents bear in that area? And back into it that way. Because if you can't refinance out of it, or you can't sell it, then I'm stuck too, just like you as the borrower. So we don't want that to happen.
So let's cover real quick before we wrap up here. What would be the first, what's your due diligence checklist like? As I'm thinking about this, my first things would be, well, what kind of investment it is, right? Obviously you're going to want skin in the game. But as we're talking here, I think part of what we want to ask is, do you have any other rental property? What's your schedule of real estate, right? As an important part of checking out that jockey or that borrower. What would be the top 3 things that you're looking at when somebody says, hey, I'm looking for a private money loan, that you want to analyze this person or their circumstances on, as far as experience goes? Because some people might have a lot of experience, or they might have done like 5 deals, but that doesn't seem to be good enough to know that they have some experience, right? How do you know if those deals even made money? right? And what do you look at in that regards to your due diligence?
Well, I wish it was a checklist thing. And this is why I wanted, so badly a community when I was starting out to be able to ask questions, because no two deals are the same. The borrowers are not the same. The title report's not the same. The pro forma is not the same. And so you can ask a lot of questions, but it's that data synthesizing, it's the critical analysis of the responses back that might lead to more discovery. And that's the nuanced piece of private lending that makes it so difficult, because really I just need to make sure that it's not going to be owner occupied. I need to make sure that the funds are going to be used for business or commercial purposes. And I want to know a little bit more about the project and the property itself. Before I can look at the borrower and their experience, I really want to see the viability of the project. And I really need to know that it's not going to be a usurious or commercial loan. And so those are the first three. After that, it's the wild, wild west. And that's why we wrote the book, is because you can look at a deal from a number of different angles, and it's trying to sort out, okay, you told me you have a rental portfolio. Well, I'm going to go and look into that, and I'm going to verify it on King County records or the county records and make sure that your name is actually on title. Sometimes it's not, right? Sometimes they act as a GC and they say they participated in all these projects, or maybe they just were a capital partner, but they didn't actively participate in that flip. And so it's asking a lot of these follow-on questions to really understand and piece together a holistic picture. And you're never going to know 100%. You have to be able to ask just the right amount of questions that you can internalize and process. But if I go and ask them for a credit report, I go run one and I can't read that credit report because I'm just a lay person lending out my money, on the side while working a busy tech job, well, then that's kind of worthless, right? So the book, we tried to help outline a lot of the contemplations and considerations that you should look at as a private lender. We tried not to give, checklists or really hard and fast answers of yes, do this, if this, then do that, because it's really iterative and it's really personal. And so we wanted to present a lot of the key considerations, like if you gap fund, this is the issues that you might encounter. I'm not telling you not to, I wouldn't do it, but here's how you can further secure it with adding another piece of collateral or asking him to bring in another partner, something of that nature. And so that's what the book was designed around. And that's how we operate too, is it's really not just a checklist. It's kind of looking and piecemealing together a whole picture.
Well, that makes sense to me. Consider, you guys, this your Christmas present from me, that you have learned about that there's a book that exists called Lend to Live with Beth Johnson and Alex Brashears. What's funny, because we were talking about our kids earlier. I have, some of the smartest investors I know started thinking about real estate investing in middle school, and you have kids, Beth, and I started talking to my kids about real estate, talking about they're going into high school this year. I have twin girls and they're starting high school this year. So it's kind of the college thing is on the mind, and I'm trying to teach them like, hey, you guys are never going to go out and get a job and then go buy a house. You're going to buy a piece of rental property. You're going to buy a multifamily that you're going to live in one unit and rent out the others. Maybe we're going to start that when you go to college and so forth. I have one of my daughters that has clued into the fact that owning real estate, she doesn't want to operate it necessarily. She doesn't want to be the property manager necessarily, but she has secured in her mind the idea that owning real estate will give her financial freedom, so she can go do what she wants. So I decided for Christmas, I am going to actually I'm going to see I'm actually even going to bribe them, to be honest with you. And they're old enough to understand this stuff now. I'm going to buy them like 4 real estate investing books, your book, maybe, so they understand it, Jay Scott's books, maybe some of the bigger pocket books, and, incentivize them to read those books, as a Christmas present. They're probably going to think I'm an idiot, but, I hope you guys all go out and understand that 2023, it might be a tough time to buy real estate, or you might, things might slow down. Who knows what's going to happen? It's a great time to consider adding in being a private lender into your portfolio, your investment strategy, your diversification plan. And this book is probably the best thing you can do to get for yourself here, as well as get to know Beth a little bit more through all her podcasts and, connecting with Flynn Family Lending. So we went a little bit long here today. And I appreciate you, Beth, coming and joining us again after all this time. Beth and I were talking about that we need to start like a support group for moms and for, gals in their 40s and 50s that are able to be hard charging investors all the time and yet keep up with everybody with all the investing and the lending and the running the businesses. So maybe that'll be our goal. You wrote a book in 22, Beth. Maybe you and I will start a support group for busy moms in 2023. That'll be
I'd
one
love
of our,
that.
right?
Thanks for having me.
Absolutely. So what's the best way for people to get a hold of the book and to engage with you and learn more about how Flynn Family Lending can help them start invest or being private money lenders?
Well, it's available on biggerpockets.com and Amazon. I would suggest getting on a Bigger Pockets. You'll get access to a little bit more bonus content. In addition to the book helping you really understand the entire end-to-end loan process from the viewpoint of a private lender. It's also great for borrowers to really understand how to be able to attract private lenders by understanding the point of view of the private lender. So we like that. And there's all these checklists and additional resources available on top of the book. To your point, Julie, about how to really get started and having some practical application on it. Biggerpockets.com has a few extra bonus materials on there as well.
Awesome. So Beth, last few things I'm going to ask you before we let you go. Where do you like to go to continue to learn yourself, either as an investor or a lender? I know we covered that's how you met Alex in the first place, but what are your go-to places that you go listen to podcasts or you attend meetings or groups? What are your favorite continuing education things for Beth Johnson or events?
Oh, well, I like to attend a lot of local events around here, hosted by BRRRR or other. The REAPS is a fantastic association to be part of, and they have monthly meetups all across the Sound. And then from a listening and viewing pleasure, I always like to listen to Bigger Pockets. I can't get my kids to look at books, and your twins are the same age as my son. And I think I have an even harder time getting him to think about anything other than World Cup. And so the way that I'm able to just at least get in the idea that it's not just enough to earn money. You have to make your money earn money while you're sleeping, whether that's through real estate or any other investment option. So I'll just keep Bigger Pockets podcasts playing in the background whenever I'm carpooling them to school and to soccer practice and soccer games. I have it running incessantly in the background to the point where they actually know like some of the catchphrases in there, but hopefully they're getting some of it by osmosis.
Exactly. I do the same. I did use the word bribe, though. Remember that I bribe my kids to do these things. And then they get a little interest like that. I bribed them for so long. One of them went, okay, I think I understand now. You know what I mean? To listen, that's fantastic. What are you using in your daily life? Like, are there any tech things that you use to help your life easier in your daily job or your daily, whatever you're doing? We always like to share, what are your favorite things that you use? I use like PropStream I'm even as a real estate broker, I use PropStream. I think there's a lot of information I can get really fast on there. Are there any type of apps or, things that you use when you're evaluating deals?
Well, I love using online tools like Pelago.com. I think it's a great way to be able to do some deal analysis, not only as an active borrower, but also as a lender. It really does a great job at comping things out and helping project out the ARVs. So that's a tool that my team likes to do because part of our agility of being a local lender is that we have to do in-house valuations. And so sites like Pelago.com really help facilitate that quickly for us.
Can anybody use Pelago?
They can.
Is it just a subscription?
No, it's not. It's their platform is free. If you're an agent, if you're part of Gideon's brokerage, then I think there's some additional tools on the back end. But we don't have a paid service there, and our team uses it pretty readily.
Well, good stuff. Joe, what about you? What's your favorite thing that you use every day? He's the one he's all into this kind of thing.
I've started using this really cool, what would I call it, like business organization tool called ClickUp. And it basically allows me to see projects along like a timeline. And then I've started plugging other people and VAs into working on those projects within the app. So that's been something that's been very cool for me lately.
There you go. A little plug for ClickUp. All right, guys. Well, good stuff. Well, we are right before Christmas. We probably are listening to this after Christmas. So happy New Year. And I hope that you all go out and reward yourself and get this book. Go to biggerpockets.com. Like Beth said, you can do it right now. In fact, Joe's going to drop a link to it in the show notes. And there you go. Right. Well, good stuff, Beth. I hope to see you soon. Thanks again for taking all the time today. I know you're busy, and so we value your time very much. Joseph, happy holidays to you, and happy holidays to all you guys, and we'll see you next time. See you later.
Thanks.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.